Canada is officially in a recession. 2 straight quarters of economic contraction. Millions of people feeling it at the grocery store, at the pump, in their savings. And most investors? They're either frozen, or they're making moves. Canada's GDP declined 0.1% on an annualized basis in the first quarter of 2026, after an even larger contraction in the final months of 2025. That's the textbook definition of a technical recession, 2 consecutive quarters of negative growth. The Parliamentary Budget Office now projects GDP growth of just 1.1% for the full year. Inflation is still running at 2.6%. And the Bank of Canada, which cut rates by a full percentage point last year, held its overnight rate at 2.25% at its June meeting, signaling that policymakers see little room to move further. For Canadians, this isn't just a headline. It's higher prices, slower wage growth, and a government that, as of this month, is sending grocery benefit payments to over 12 million people. That's nearly a third of the country. Here's the thing most people get wrong about recessions and investing. They assume it's all bad. But historically, recessions don't destroy markets, they shake them. They separate the investors who are positioned well from those who aren't paying attention. Volatility moves in both directions. Oil dropped over 3% in a single session this week on US-Iran peace talks. Sterling moved on a prime ministerial resignation. These kinds of swings happen faster and more often during economic uncertainty, and for investors with the right tools, that's not a threat. It's information. So what are experienced investors actually doing in this environment? A few things stand out. First, they're not sitting in a single asset class. Multi-asset exposure, across forex, commodities, indices, crypto, and equities, means no single downturn can take out an entire portfolio. Industry data from this month shows multi-asset trading volume surging across platforms, as traders respond to exactly the kind of cross-market moves we're seeing right now. Second, they're leaning on data, not instinct. In a recession, market sentiment shifts fast. The investors pulling ahead aren't necessarily the ones with the most experience, they're the ones with the best information, and the tools to act on it quickly. Third, they're using platforms built for this speed. Because in 2026, waiting for a morning news alert to make a trade is already too late. That's where Gerard.McMann comes in. This is an AI-powered trading and investment platform headquartered right here in Montreal, built for exactly the kind of market conditions we're in right now. But what sets it apart is the speed and intelligence built into the execution layer. We're talking about a platform that positions itself at Formula 1 speed, 90+ order types, algorithmic trading capability, real-time confirmations, and AI analytics surfacing opportunities before most traders have even opened their charts. For Canadian investors specifically, there's another angle worth noting. Gerard.McMann offers IRA and retirement account options, tax-deductible contributions, which makes it relevant not just for active traders, but for anyone thinking about long-term portfolio positioning during a period of economic uncertainty. Canada's recession isn't going away overnight. The PBO projects weak growth through 2027. Inflation is still above target. And the Bank of Canada has limited room to cut further. That environment rewards investors who are prepared, diversified, and working with better tools than the average person sitting on the sidelines. If you're in Canada and you're wondering what your next move is, whether that's active trading, retirement planning, or just getting a clearer picture of your options, Gerard.McMann is worth a serious look. The link is in the description. There's a free consultation available, and getting started takes minutes. The market is moving. The question is whether you're positioned for it.